Davis here with another tax saving tip for you, and this one is about the changes in dividend tax, which are going to have a quite big impact on entrepreneurs, because dividend tax is changing on the 6th of April 2016. And for entrepreneurs and business owners, it's likely to lead to an increased tax bill. So therefore, if you've got profits in your company, it could be worth paying an additional dividend before 5th of April to make the most of the current rules. So what are the current rules? Well, until 5th of April 16, no further tax is payable on dividend income that falls in your basic rate band. This is because dividends are deemed to be paid net of a 10% tax credit, which conveniently for basic rate taxpayers, the tax on dividends income is exactly matched by the 10% tax credit, meaning no further tax is due. It's quite circular that, ultimately. If you're basically a taxpayer, you don't pay tax on your dividends. So in this year, if your total income doesn't exceed £42,385, the dividends are paid without any tax bill. But once the higher rate threshold is reached, tax is payable at an effective rate of 25% of the net dividend. Then if you earn more than 150,000, the effective rate becomes 31% of your net dividend. But the new rules coming in from 5th of April 16 mean the dividend tax credit's abolished, and instead you'll be given a tax-free dividend allowance at £5,000. But then after that, dividends will be taxed at 7.5% while you're a basic rate taxpayer, rising to 32.5%, while you're a high rate taxpayer, then up to 38.1% if you earn more than £150,000. Basically what it means is you get £5,000 tax free, then the tax on dividends is 7.5% higher than this year. And for some entrepreneurs, it can be a much higher tax bill. So how can you save tax by planning ahead? Well, if you do own your own company and you haven't used all of your basic rate band for the year ended 5th of April 16, you cut next year's tax bill by advancing your dividend payment forward into this year and using that tax-free bit of dividends up. So how does this actually work? Well, let's use an example. Dave's an IT consultant, provides his services through his own limited company, and for the year ended 5th of April 16, he's paid himself a salary up to the personal allowance of £10,600 and also had net dividends of £15,000 a year. Now, in the year, he won't pay any further tax on that dividend income, which means his taxable income for the year is £27,267, which means he's got over £15,000 of his basic rate tax band unused for the year. Now, if in 2016-17 he continues to pay himself effectively exactly the same, salary up to the personal allowance and dividends £15,000, he's going to pay 7.5% on his dividends over that £5,000 tax-free allowance, which means 7.5% on £10,000 of dividends gives him a tax bill of £750. So his option then is to pay that £10,000 before the 6th of April 2016, because it actually falls within his available basic rate tax band this year and there's no tax on it. So his option at £10,000 is pay it before 5th of April 16 and pay no tax, pay it after and pay £750 of tax. So you can see there are opportunities there to plan. Now, it will come down to your personal circumstances, but it's well worth thinking about and speaking to a specialist. So if you haven't used your full basic rate band this year, advancing some dividend payments could really save you some tax when there's new dividend rules come in. So if you've got any queries, please do get in touch, use the details below. Hope you found this useful, and if you have, please subscribe to our channel and get more tax saving tips from us, and I'll see you soon. Thank you.